number of years ago, I walked away from being a Wall Street advisor. Why did I do that? It's because I saw behind the curtain, like the Wizard of Oz. Seeing what's actually there is that Wall Street is dependent on you. They make their money on you. And if you don't invest, they don't get paid. And it's amazing the misalignment of interest. A lot of investors just don't realize that Wall Street is set up to take fees even if you lose money. When you lost 50% of your portfolio in 2008, they're still getting paid, right? So there's this misalignment of interest. There's actually studies that show that over 50% of fund managers managing over $100 million in Wall Street type funds, stocks and bonds, they have $0 invested in those accounts, right? That is not the same thing as a lot of alternative deals that like our deals or other people's deals where they invest money along with investors. So we're going to go to this in 3 steps, why Wall Street's not out for you and how you can basically avoid getting into their traps and what you can do next. Okay, so my name is Bronson Hill. I'm the CEO of Bronson Equity. We do investment deals. We help people with multifamily, other types of investments to provide cash flow, appreciation, and tax benefits. I'm glad you decided to join us on this video. This is not investment advice. I'm just simply sharing my opinions. So Wall Street is really designed to keep you dependent. We talked about that. The high fees. Tony Robbins actually talked about in his book, Money Master the Game, where fees are coming down. But basically, commonly, a lot of these products, if you have a money person from Morgan Stanley, from Smith Barney, from these Wall Street, Merrill Lynch, one of these groups, they're going to charge you typically 2% on the top of everything to manage your stuff. So if you have a money person, this video really is for you. And then also they're going to charge fees for their products, right? They're going to charge additional fees. They'll say, we'll put you into this fund. It's got 1.2% fee. It's a low cost fee, whatever. But legally, I don't know how and to me, this seems completely unethical. I don't know how this is legal. You tell me, but they can basically say the fees are 1.2%, but they have all these hidden fees like administrative fee, cash drag fee, total BS fees, but they do not legally have to tell you that they're there. So Tony Robbins talks about in this book, he says they'll say 1.2%, it's actually 3.2%. So if you have those two together, you have a money person and they're putting you into their own products. And how you'll know this is they'll say, this is our Merrill Lynch fund, 2035 or 2055, whatever timeline horizon that is. And so typically if you're in something like that and you have a money person, you're paying both fees. You're paying the 2% to have an advisor and you're paying the 3.2%. So you're paying over 5%, which typically returns are only 6 to 9% per year in the stock market. And there's some volatility. So they're taking most of your growth in fees. So it basically becomes a glorified bank account. So if you need somebody to help you save, pay the money, but it's a very expensive way to have somebody tell you to simply save and pay the money. So this is what I discovered really about true wealth is that, you'll see on this chart here that we pulled up that $1,000 a month invested at 8% over 30 years is about $1.4 million. But if you have fees there, those fees, you're losing $463,000 of that. You're losing a substantial amount of it. And this is kind of a lower projection than what I shared, but it's still it's substantial, right? So that's something that's really important to pay attention to. And then what I've really discovered about true wealth is that tangible assets is how people become wealthy. There used to be a time where people would say about stocks, why in the world would you ever invest in stocks? Why would you ever do that? Because between 1929, when the stock market crashed, and 1954, it was a 25-year period, and stocks were flat over 25 years. So they crashed, came down 89%, did not recover for 25 years. So they were seen as inherently very risky. And so people were buying things like, they call them alternative assets now, but they were real assets, physical, tangible things, right? Businesses, they were buying houses, they were buying real estate, they were buying physical metals, they were buying things that they could. Physical metals, it was a little hard to buy physical metals during some of those years, but things that were tangible that produced assets. So that's where we found you're just going to do much better over time. If you look at the data, it shows it's about a 2-to-1. If you do invest in the stock market versus you invest in a diversified alternative asset portfolio, and I'm not talking about REITs, I'm not talking about putting money in some diversified Wall Street product, but actual ownership. Either you own it and you operate it, or it's something that you're a passive investor in a deal and you're a part of that. You're an equity owner of that property or that particular business. So really, how do you take control, of your finances? How do you take control in this area? Well, the thing is, I would say the biggest thing is you invest in yourself. You invest in your own education. If you can invest in your own education, you're going to see dividends that, just like you can't even believe. So I think that's a huge one. Diversification is important. It's important to have some diversification. So it's not all in one deal. I have somebody who notes says don't ever put more than 10% of your net worth in one deal. Depends how wealthy you are. If you really are going for it, maybe you have some active role in it, maybe it makes sense. I'm pretty heavily diversified, pretty heavily focused into multifamily. We started to diversify into oil and gas. We've also done private businesses that are very high cash flow. We found different things to get into. I also do physical metals. So these are things that for me provide some diversity. It's important to have some diversity. And I obviously like the alternatives. So this is a quote I love, and I want to share this with you. Financial freedom is available to those who learn about it and work for it. Robert Kiyosaki, right? So it's important that you're working for it, that you're learning, that you're growing. And again, when you educate yourself about stuff outside of Wall Street, I know things are challenging. So we've had deals go phenomenally well. We've had deals go okay. We've had a few deals struggle, right? So it's important to continue to learn. But the biggest investment you really make is in your own education. So if you haven't joined our investment club, you're not hearing about these awesome deals we're doing in multifamily, in oil, gas, in private businesses. We'd love to share those with you. You can click the link below. Love to hear your comments as well. What are things you're doing in the alternative space that you're finding interesting? That have you come to the other side of the man behind the curtain, as in the Wizard of Oz, and seen that, these stocks, these bonds, this advisor is really not going to help me? So I'd love to hear about it. Look forward to seeing you on the next video.